Man, you know it's a bad day in the market when my friends, my family calling me, texting me, say, hey Kyle, I don't know where to put money. Gold, silver, inflation hedges, crypto, real estate, them oil stocks. Don't matter where you put money right now, it looks like this. It's just burning. And yes, I'm feeling just the same pain you are. I am down over $50,000 as of today. And I want to kind of have those discussions that I had with my family. Now, I can't offer investment advice, but damn, I can give you that inner perspective look into how I'm strategizing and looking at the future and my own personal goals to kind of give you a framework that hopefully you can work into your own risk tolerance and see what you're doing. Because I hear both sides of the fence right now. I'm hearing people saying, oh, you need to concentrate, find those great growth stocks and buy into them. And then people saying like Dave Ramsey, you need to diversify, you need, if you aren't diversified, that's why you're losing all this money and you're an idiot. I don't know. You kind of got to figure out where you fall in the middle because they're all right and wrong. So first and foremost here, folks, if you appreciate the conversation, hit that like button because I'm going to be going over a 4-stage strategy that I'm going to be implementing into my own personal portfolio. I had to really sit down and look at my long-term goals and figure out exactly what I'm doing. And to take full advantage of this current recessionary period, I wanted to get all my big expenses out of the way. I went and paid over $1,000 to get my brakes, rotors, and my car fixed. I'm going to be dumping over $500 into my phone bill just so I don't have to pay it for the next year. And I am looking to sell things. Like I am getting aggressive with trying to do anything to get cash because I'm concentrating, making sure I got my 3 to 6 months emergency fund set up. I'm going to be adding a new cash strategy. We got lots to go over in this video, so consider hitting that like button, folks, because we're going to be having an intriguing conversation tomorrow. I have the pleasure to be joined by Let's Talk Money, a good friend of the channel here. I managed to get on it, pick his brain. Smart guy, really understands this stuff. I suggest you watch some of his videos. I know many of you that watch this channel are already a fan, but we're going to be getting deep into the recession, his thoughts, and what aspects of the market and strategies he's implementing. But first and foremost, folks, baby, the fire continues, and I hope it continues to. I know it's kind of one of those unhappy things to say. People get all up in arms, like you wish the worst on everybody in a recession, and obviously, like I'm getting hit. I mean, my income could drastically slow down. In fact, it is. I mean, you look at advertising rates, and all this stuff is kind of not nearly as congruent as it was last year, right? But nonetheless, again, I mentioned it yesterday. If you're very strategic, you're frugal, and you're doing what I'm doing, you should very well be able to take advantage of this. A lot of people cost averaging into this, and when my family and friends call me up and we have this in-depth conversation about how much volatility can you handle? I mean, I got 5-10 years to let this do its thing. I can continue to buy really great assets like things like Google that I've been looking at. But if you're older, and a lot of these people are kind of getting to that retirement phase, the things that I would usually talk about are things that I buy but in index form, because you don't want to have to manage this into retirement. And look no farther, for Canadians nonetheless, than the Vanguard FTSE Canadian High Dividend Yield ETF. Now this thing, unbelievably boring. Year to date, somehow still green, and it literally holds all of my favorite stocks. One of my biggest complaints is you could pretty much buy these individually because 70% of the portfolio is in the top 10. But you don't want to manage this, right? And the expense ratios are low. We'll look at it in a second. But look at this: Royal Bank, Toronto Dominion Bank, Enbridge, Bank of Nova Scotia, Canadian Natural Resources, Bank of Montreal, TC Energy, Suncor, Canadian Imperial Bank, Bell Telecom, right? Like basically, if these things get different weightings or something starts to collapse, they'll auto weight them for you. That's the point of the ETF, right? And just take a look, because this thing's yielding, I'm not sure the exact yield. I think it's 3.4 to 3.8%. The expense ratio is pennies on the dollar, 0.21%. The expense ratio on the actual Vanguard site says that's 0.2 here with a 3.46% yield. But I love it because it does pay that monthly dividend. So this is actually where I'm looking to concentrate my new money. Some of my Canadian stocks, the income. I was kind of on the fence with doing this, but I figured, we're going to talk more about the strategy in my 3 ETFs that I'm kind of focusing on, but this has become one of them. But with other volatility problems, this thing could still drop. It has historically, in periods that weren't even recessionary, drop upwards of 20%. But if you do not want to deal with that, look no farther than an interest-raising environment when it comes to guaranteed investment certificates. I briefly talked about this. I don't own them. I know a lot of dividend investors. I even know like PPC Ian, a lot of those big dividend guys are even getting into bonds. But this is from Scotiabank. Every bank offers something slightly different. But on a 4-year yielding 4%, if you purely want cash flow, I mean, a 4% income with zero volatility, how do you go wrong, right? And I mean, over a 5-year period, you can get up to 5% or up to 50%. And the way they're doing that is they're backing these bonds up that are market linked. So this one specifically is linked to the Scotia Canadian Utility Fund. And if you want to see how banks invest their money, very intriguing. This is where they go for complete security on the Canadian border side of things with Scotiabank, because this specific ETF, the iShares S&P TSX Capped Utility Index, ticker symbols XUT, it pays 4.15%, guys. It's got a pretty high, well, 0.5% expense ratio, a little higher than I'd like it. But nonetheless, take a look at this because these are all your favorite Canadian utilities: Fortis, Brookfield Infrastructure, Emera, Hydro One, Algonquin Power, Northland Powers, and a lot of my favorite utilities, right? But the cool thing is they have other GICs backed by other index funds. They have one here, the Scotia Canadian Top 60. So I talk about this, the S&P TSX Top 60, which to me is pretty much the same thing as VDY. They have very similar performance. If you look at a bunch of different ones of the the Canadian composite version of the S&P 500, but they have that in there here as well. There's the utility ETF, and then they have the Canadian Low of Volatility Index. So if you're looking for retirement, look for what the banks do. I mean, you could easily just buy these on their own and not get into the GIC, but the whole point is to figure out your own personal strategy. And I want to give you a little insight into mine. And I'm going to expand on this a lot farther tomorrow because I realized it's been a while since I've sat down and actually assessed my goals. And the market dropping to me, again, is not the biggest deal in the world. It's more or less just an opportunity for me to concentrate, readjust my risk tolerance. And you guys have been seeing me kind of go through this emotional ordeal along with you, I'm sure, throughout this year. It's been very interesting to say the least. But nonetheless, I picked this kind of 4-bucket strategy. And the 4-bucket strategy consists of the S&P 500, the ticker's VOO. Many of you know I've got a huge position in that already. VYM, the US basically dividend aristocrat ETF, already own a lot of that as well. I started adding a VDY. That'll be my Canadian income, which is the same as the S&P TSX 60 to me. I don't think I really need to own more than one of those. And then I'm going to basically be buying another big portion of individual stocks. The goal is 100,000 in each one of these buckets. So S&P, VYM, VDY, individual stocks, and then I want to get a cash position somewhere between 80 and 100,000 somewhere in the next 3 to 5 years. I'm really not too far out from that goal realistically from where the portfolio currently sits. So I am sitting in a good spot, but I'm really going to expand on this, show you guys how I've been kind of working this strategy into the current portfolio. And the whole idea is really lowered risk tolerance from volatility risk. I'm still going to hold high volatile assets. I've been buying Bitcoin today. I mean, I'm just going to make them a much smaller weighting. I'm looking at Google, Alibaba, and I'm, like I said, if this can span out for a full year of just kind of this sideways downward trending, I think this is an incredible opportunity for everybody that's got a 5, 10, 15, 20-year time horizon, because it makes sense all of a sudden. A lot of things are starting to make sense. And, the lower the market goes, the less risk you're actually having. It's when it's kind of pushing toward all-time highs is when you're getting the most risk, right? Technically, it's kind of an inverse way of thinking about it, but because, valuations can only get so low before you're kind of getting into what Buffett defines as a margin of safety, right? But I want to pass the question off to you. What is your strategy in this market? I think it's going to be a good discussion moving forward, and just to kind of help some people out, because man, it's one hell of an interesting market, isn't it?